morning, everybody. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with KPP, joined with my colleague Ben Hopper. And today we're going to talk about the markets, where we are right now, specifically the S&P 500. And we're going to talk about some tried and true methodologies of staying the course and ways to potentially improve your odds of growing your portfolio over the long run.
Yes, very excited to be here. It's been a while since I've joined you, Kyle, so thanks for having me on. But I think these topics are something that we hear day in and day out when we're meeting with clients, when we're meeting with prospects, when we're just having discussions out with our friends who know we're financial advisors. That's the first thing they ask is, what's going on right now? Where should I invest? What should I do? And so hopefully some of these topics that we talk about today are helpful in that arena.
Yeah, and it is funny you mentioned that. Everybody right now, because the markets have just been on a tear in the recent past, especially after we came out of COVID, the returns that we've seen in the S&P and the Dow and the NASDAQ have been unprecedented, really. It has been the fastest recovery in the economic and the financial markets ever, after any recession ever. And being out and about, you're right. Everybody seems to have an opinion, for better or for worse. We want everybody to have an opinion about the market, but it kind of harkens back to a time where I grew up in Massachusetts, and the Kennedy wealth, I don't know if you're familiar with this story, but John F. Kennedy's father built his wealth by selling short the stock market when it crashed in 1928. Do you know that?
And why did he do that? I have heard this story from him before, but go ahead.
Oh, I do repeat myself quite a bit, all right? So thanks for putting up with me. But he shorted the stock market because he was getting stock tips from his shoe shine boy. Now, it seems like everybody is an expert today, which is fine. I think the freedom of information, the ability, the technology for people to access information and make stock picks is great. And quite frankly, it's driving a lot of the growth in the market. But there's danger in that.
That's right. Everyone becomes their own expert. And so what we want to talk about here is just staying the course and keeping things simple. And what are some certain metrics we can look at right now to give investors confidence and awareness and education. So Kyle, if we start, you mentioned already the three of the main indices. Let's start at a very high level. What are the differences between the Dow, the S&P 500, and the NASDAQ, and what are we going to focus on today?
So today we're going to focus on the S&P 500. The NASDAQ is a technology index, companies that are in the tech sector, and the Dow Jones Industrial Average is comprised of a very small number of the largest companies in America. So the S&P 500 is a market index that is comprised of the 500 largest companies in America that you buy and trade. And when people talk about the stock market, generally they're talking about the S&P. So we're going to talk about the S&P, and it's really important to understand that when we talk about the market, the S&P 500 is one market. It's one market. It's one place that you can invest your assets. You can buy ETFs in the S&P, but when people talk about the market, it's generally the S&P. And we're going to talk about the S&P specifically right now. But to your point, we're going to also talk about diversification and why the S&P 500, A, it's important to understand, but B, it's also important to not put all your eggs in that one basket.
It's very easy for those that invest in equities and in stocks to compare their performance to the market. If my advisor is doing better or worse in the market, am I doing, as an individual investor, better or worse in the market? But it's important to understand that how you're invested, the S&P 500 might not be the best index to compare yourself to. And we'll talk about different sectors, different weightings. You might have international, small cap. All that means you might be better off using a different index to really compare your results in the best way. But let's...
and check out our website. We've got a great video on there that's titled Comparison is the Thief of Joy. So if you're comparing yourself or your performance to something that's irrelevant to you in your life, that will just sap you of your life. So don't do that. Don't do that. We're here to provide advice for life. We want you to live richly. So let's dive in. So the information we're going to walk through is from our good friends at JP Morgan. Every quarter, JP Morgan produces a piece called Guide to the Markets. It's a quarterly update on the economic conditions of the financial markets. KPP, KPPAS, and LPL Financial are not affiliated with JP Morgan. They provide us great services and really great products that we're able to offer our clients. And for that ability to provide their products and services, they give us great insight into what their economists and their people at their home office, their money managers are thinking. So this piece, Guide to the Markets, is actually client approved. So if we say something that you like or you want to see more of this document, you can call our office at 502-394-0400. We'd be glad to email you the piece so that you can dive into it more. But there's a chart in the Guide to the Markets piece that tracks the S&P 500. It's on page 4, and I'm going to try to hold this up to the screen so you can see it. What this effectively does is it shows the returns on the S&P since 1996. So the last 25 years on the market, we've had a pretty interesting ride. Throughout the late 90s, we had the tech bubble that came down and crashed in 2000. Then we saw the run up to the mortgage collapse in 2008 to 2009. But if we look at this chart here, at the last 11 years, even including the COVID-19 bubble or the COVID-19 dip last year, we have had unprecedented returns. It has been an extraordinary 11-year period, and on average, for every 4 years in the S&P 500, there is at least one, on average, 20% decline or more. Now, fortunately, we saw that last year. It was a tough time. I say fortunately because we've seen the unprecedented growth. But when we look at this chart, we have to think, my gosh, are price valuations a little high? Is the stock market frothy? And we're getting that question quite a bit.
Absolutely. It's felt like it's really easy to get good returns, to make money, quite frankly. It's felt easy lately. Kyle talks about it a lot. It's like, what's going on? This seems too simple. And in a lot of ways, it has been. So knowing that this is where we're at and seeing that historical chart is a very important perspective to keep.
That's brilliant, and you're right. I got into the financial services industry in 2001 was when I started. And it really was it was a time where I had no money, right? I didn't have any money to invest at the time, but I knew and I could feel, even at a young age, the stress that people had as the markets were going down. Granted, I was in the insurance side of the business, so it was a great opportunity to help people understand protection strategies and things like that. But I've lived through now 3 recessions, if you include the COVID-19 crisis last year. And it's true, I had said that to you. It just seems too easy. Now, math doesn't care about your feelings. The economy doesn't care about your feelings. So we always want to be careful when we're managing money, but it has seemed frothy. So what we want to do is delve into the math. Mathematically, what does the market look like right now? So if it seems like things are expensive to you, or if it seems like the markets are frothy, what we have here is a chart that shows that it actually is. This is a very detailed chart. So we don't want to get too deep in the weeds. But what this chart effectively walks through is what's called the price to earnings ratio of the S&P 500. So a good way to think about it is historically how expensive are stocks in the S&P 500 relative to the average. The average price to earning ratio is at 17. Right now, or is at the end of March, we were at a 21.7. Okay? Now, historically, we always want to remind the audience that we do not have a crystal ball. We cannot predict the future. Past performance is no indication of future results. But in the last 25 years, JP Morgan looked at the next 12 and 60 months, so the next 1 year and 5 years after PE ratios, after the PE ratios at the time. And every time the PE ratio got to where we are today, the rolling 12-month and rolling 60-month period in the S&P 500, it was very difficult to make money. because companies had grown to a point where they were expensive, and the growth after each of those periods was flat. As a matter of fact, this chart shows over the trailing 5 years after a PE that we have right now, the growth on the S&P 500 on average was close to zero, which means that that feeling that you may have about a frothy market, about prices and stocks being overvalued or being expensive, historically they are. Now, we may be in a period where, I always like to say, somebody's got to make the average, right? We might be in a period where the next 5 years continue to run in the S&P, but history tells us that historically it hadn't.
So, although that may seem scary, Kyle, why would you say that if you're invested right now, you have been for years, why should you stay invested?
Great.
If that's the data.
That's right. So effectively what I just said is the market's not going to do anything for the next 5 years is what the data says. Well, that's where we go back to where we started. The S&P 500 is not the market. It is a market. It is one market. There are countless places where you have an opportunity to build a portfolio and diversify your assets. So we'll talk about sectors and asset classes. And it's so important to know and understand that the S&P is made up of 500 companies, but there are thousands of other opportunities, international companies with which you can invest your money. You can invest in real estate, you can invest in commodities, and building a diversified portfolio and working with financial advisors that are looking at this type of data. It's our job for our clients to be able to understand where we are. There's an old saying, to understand where you're going first, or to get to where you're going, you first need to know where you are. We are looking at where we are right now and trying to make sure we're helping our clients build that diversified portfolio so they have access to those markets that have a high likelihood of growing their wealth.
Exactly. And ensuring that their financial plan is aligned with their investment objectives. Starting with that plan, we've talked about that a lot in the show. We're specifically talking about investments in the markets and that sort of thing, but that is not everything there is in financial planning. So starting with that plan and then using these concepts and using these baselines as an investment strategy and relating the two together is key. And that's what we do as financial advisors.
That's right. And to answer your question again, you found a great chart in the Guide to the Markets brochure that talks about staying the course, right? So based on what I said, if you shut the video off when I said, that the next 5 years historically don't look good, well, if we look historically at the risk of trying to time the market, it really is fascinating. So walk the audience.
This slide really does speak to that concept of staying the course. We don't have a crystal ball, and this is why you don't want to be going in and out or hesitate, so to speak, of being in stocks, of being in equities, if that's in line with your risk tolerance. And it's because this chart shows that the returns of the S&P 500, this is from the time period January 2nd, 2001 to December 30th, 2020. So about 20 years. 20 years, if you were fully invested in the S&P 500, your annualized return 7.47%. But that is if and only if you never got out.
So if you put in your investment in the market in
2001.
So in 2001, and crawled under a rock and didn't move it, didn't look at it, and woke up December 30th of last year, you would have averaged 7.47 annualized return.
That's right.
So you take your emotion out, you just let it go, 7.4%.
Now, had you said along the way, I think I'm going to get out of the market, I'm scared, something's going on, I feel weird. Maybe it was after 2008. Maybe it was after or during COVID. Maybe it was along the way at some point. If you had said several times and done that and missed the best 10 days, so just 10 days out of that 20-year period, if you had missed those best 10 days in the market, you would have averaged 3.35%, which is less than half.
Wow. So you did the math in your head before the class. How many days is that over 20 years?
Well, I just was spitballing, but I think it's like 8,000 or so, right?
So 8,000 days. So of 8,000 days, now granted not all were trading days, but 8,000 days over a 20-year period, if you missed the 10 best in the market, your return on your investment would have gone from 7.4% to 3.5?
3.35.
3.35%. So that's less than half. And that compounded effect of that 3+%, almost 4% growth that you missed could mean the difference between retiring comfortably and not retiring at all, quite frankly.
Exactly. Or at least delayed retirement.
What if you missed the best 30 days?
Yeah, so we're going to keep going here. The best 30 days, you would have had a negative 1.49% return. Negative 1.49 if you miss the best 30 days along that 20-year period.
That's incredible. So and by the way, if you were going to get out of the market, when would that have been? Do most people get out of the market when it's roaring and things are going up and it seems easy to make money? Or did they get out when seas get a little rough?
When they get rough.
Right? And what's the last part of that chart that our friends at JP Morgan
So why are these, this might seem like crazy data. The question is, why is this the case? And this is math, but why? And it's because 7 out of the best 10 days occurred within 2 weeks of the 10 worst days. So that speaks to the volatility of the stock market. After big declines, that's when a lot of astute investors, you might hear, it's a good time to buy. It's a good time to buy. There's a reason for that, is because historically over the last 20 years, after the biggest declines, that has been the best time to buy. Mm-hmm. So
so the best return days usually or historically have occurred very close to the worst downturn. Mm-hmm. So it's counter to human nature, right? Yes. I've always used the analogy of driving in traffic, right? If people are just wanting to switch lanes, and we all do it at the worst possible time. And investing, it really is no different on average. When things are going badly, Warren Buffett said, when people are greedy, be fearful, and when they're fearful, be greedy. When the markets are going down, historically that's the best time to buy, but it also goes back to properly diversifying your asset and understanding that the S&P is one market. It is a market. It is not the market. Now, we may be in a position right now where the S&P 500, from a historical standpoint, it does have a higher price to earnings ratio. In other words, it's more expensive than it is on average. Historically, at this levels, we see times where it's difficult to make money in that period over the long term, but that doesn't change the fact that there are going to be periods of great returns and periods of not so great returns. And staying the course with that portion of your portfolio, and which will be determined by a comprehensive financial plan, understanding your risk tolerance, but there are going to be opportunities in there.
Yeah, that's why with a lot of our investors, we always like to say, have enough cash on the sidelines in your bank account that you feel good about your emergency funds, and in your investment portfolios, maybe look at having some things that will zig if the market zags. Maybe it's alternative investments, maybe it's international, maybe it's structured products. Who knows what that might be, but that's why diversification can make the ride a lot better.
And this chart here is one that I've used for decades. It's called a Callan chart. On the JP Morgan Guide to the Markets piece, it's page 16. So again, if you want a copy of this, we'd be able to email it to you. But what this shows is it breaks down the sectors that you could invest in. So it breaks down value, it breaks down international investing, it breaks down bonds and fixed income and things like that. And what it effectively shows is each color represents a different asset class. And you'll see here early on in the cycle, so this begins in 2006 and represents all the way up to 2020. Bottom line is each color represents a different asset class. So if anybody tells you that they know which asset class is going to be the best performer in the future, nobody really has any idea. But on average, we know that asset classes or investment opportunities, the best will always be able to know in the rearview mirror. We'll never be able to know looking forward. But we know that diversifying among those asset classes is the way to go. So even if you think that the S&P 500 is frothy, that doesn't necessarily mean you should be completely out of it, because if you have a long-term growth perspective, and again, make sure you're always sitting with a financial advisor before you invest anything. Make sure your risk tolerance, your goals and objectives are always a part of your investment strategy. But diversifying your portfolio allows you to impart some humility into your investment strategy and capitalize on the volatility when it happens, and be invested in what those markets are, or what those sectors are that are going to be doing well in any given year or over any given period of time.
And going back to Kyle's point that you made earlier, is that the S&P 500, which is what we've talked about, is just one market. So what this Callan chart will show that I wanted to mention is that, I see things on here like small cap, like value, like cyclical. And granted, some of these, the S&P 500 will kind of be in multiple categories, but some not so much. So the S&P 500 is, what is it mainly? Large cap, and it's right now it's got a little more of a growth tilt to it than value because of companies like Amazon and Google and Facebook, the FANG stocks that have taken up so much of a weighting of the S&P 500 over the last year tend to be more growth than value. So the S&P 500 fits in the large cap. It's kind of a blend. It's got some value in there too. It's got some energy, financials, and we'll talk about sectors in just a second to wrap up. But the S&P 500 is just one. So that's going back to, once again, to diversification and how different asset classes tend to outperform. It's different every year, almost.
And you mentioned, you're right, and you mentioned small cap. So another index is the Russell 1000. There's a Russell 2000. 1000 represents 1,000 companies, right? Not just 500, but 1,000. Russell 2000 is 2,000 companies. So there are certain markets and sectors that you want to be part of. So let's talk about the last piece that this chart that was talking to you here. I think you were going to bring some good points up.
Yes. So with sectors, recently I think it has become a very big conversation over the last year, especially because what's been the biggest topic and the biggest winner, at least last year, maybe even the year before, was technology. And so it's very easy to sit here and think we can always make money in tech. Tech is the future. Tech is done so well. It's doing so well. All this growth, all these new companies, all this innovation, tech is just always going to make money, right? Well, what this chart shows is that this year already we can see that there has been other sectors in the market that have started to outperform tech. Now, who knows what will happen over the long run? We don't think you should be out of tech by any means. We actually pared back a little bit on technology in a lot of our portfolios at the start of this year because it had such a great run. But so far this year, what this chart shows is that energy, for instance, has, since November of 2020, been the leading asset class. Now, if this time last year you had said that I think energy is going to start to outperform, most people would have called you crazy, right? Well, energy has gotten beat up quite a bit. Its valuations did become very attractive because a lot of investors...
Nobody was traveling during COVID.
Yeah. So energy, airlines, retail REITs, hotels, resorts, and cruise lines, those have been some of the top performers since November of 2020. So November of 2020 through, through March 31 of this year. Now, on the flip side, you've got technology that has still seen some gains. So technology is still positive, actually, which is worth noting. But the bottom line is sectors that did very well last year, so far this year, have not been the leaders. We've already started to see a little bit of a reversion to that. So.
And I love that you brought that up, because another key investment strategy that working with a financial advisor will help you impart on your portfolio is rebalancing. Because what rebalancing effectively is if technology was up last year and you had energy that had come down, if you have a systematic way to rebalance, your portfolio would have been overweight technology and underweight energy, for instance. And what rebalancing does, it allows you to sell those assets that are up, and you use those sales to buy the assets that are down, and you rebalance and you levelize the allocation that you have. And what that would have allowed you to do is participate now, or buy those underperforming assets at a quote-unquote low point, if you had rebalanced in November in this case, and you would have been able to participate in the growth of that sector. Yes. So rebalancing is one of those just integral strategies to impart in a 401k, in a retirement plan strategy, and it's one of those things that the average investor just does not do. So at KPP, I love going through the market insights, giving a more macro view. I'm so grateful to our friends at JP Morgan for providing this information. But the bottom line is this: if you are scratching your head and wondering, how can I make sure that I get this information, that I have access to this, or how can I make sure that my portfolio is allocated properly so that I am giving myself the greatest opportunity to retire confidently and comfortably, to have my assets, my investments accomplish what it is that I want them to do? I can't encourage you enough to come in, sit down with us, give us a call. Our phone number is 502-394-0400. The most important part of an investment strategy is having a strategy. Have a plan. Have a purpose for your money. Yes, we all want our money to grow, or maybe we want to preserve our wealth, but if you don't know why you're doing that, you don't have a plan, and we'd love the opportunity to build you one.
Absolutely.
Would you like to close out with anything?
Well, yeah, just maybe to add to that, it might be easier before you call in to check out our website. We have been improving that. We've been adding content to that. So these videos that we're doing, we are working on adding those to the website. Some of them are already on, so check them out there. Check out our team. Go to KPP Our Team. You'll see a list of all the advisors we have in the office, and you can learn a lot more through our website. So be sure to check that out.
Yeah, and lastly, we're actually going to be taking Coffee with KPP live on the road. We're going to be going out. We're going to be in person. Our first in-person class is going to be Thursday, June 17th at the U of L Shelby campus. With COVID-19 restrictions, space is limited. We're already more than halfway booked, but that first class is going to be on Social Security, and we're also going to be delivering in the future great events. We're going to deliver educational events, and I think we're actually going to be delivering the classroom live on Facebook as well. So there's a lot of exciting things that are going on, and I'm so grateful to be able to deliver this information to you. As always, if you have any questions, concerns, if you would like a copy of the piece that we walked through, give us a call, 502-394-0400. You can also email us. My email address is kyle.roy@lpl.com. We'd be happy to help you any way we can. As always, thank you for watching. Thank you for listening. I hope you have a great week, and we look forward to seeing you soon.